There we go. All right, good evening, everyone. Welcome to our info session. I'm just shutting off all the things that make noise. So we're glad that you could make it. I'm here to talk about our executive program and financial strategy. And my name is Kathleen Fitzgerald. Let me write that. So what we're going to do is I'm going to do, if you need to ask me any questions or anything, I'll be one of your professors in this program, should you sign up. So what we would do, this is an info session. So I'm going to do a little bit of a broad picture of the curriculum overview. And then we thought you would be interested in getting kind of a taste of what you're going to learn, as if you were learning it. It's going to be pretty high level, but you should get a flow for how the class will work, especially because the class is online. And then we'll talk about next steps. Okay, does that sound good? Everyone on board? You can write in the chat at any time during this presentation. We want to treat it as if we were in a class. And at the same time, I might ask you questions, okay? So it would be good if you answer me. I like when you answer me because then I know that you're there. So this program itself is it's called the Executive Program in Finance Strategy. So this is for people that are in many different industries. It doesn't matter the industry. It doesn't really matter your functional area. It's for someone who wants to get kind of a big picture of how things are going on and also understand how to apply the knowledge and create value, which sounds like a lot of jargon, which is why I want to go through this in detail. So there are mainly in this program 3 main modules. So there's the first module, which we're going to call financial acumen. Trying to find my favorite color. All right, so financial acumen, and it's a 10-week program, by the way. The 10-week program goes from February 25th to July 1st. I don't think it's cheap. It's like $4,500, but it's worth it. And it will be held on Saturday, late afternoons. Rashid, could you put in the chat what time it is in India at that time? I can give you a benchmark. I can tell you that they're, I think it's 8:30 a.m. Chicago time.
Yeah.
Yeah. So if you know where you are, so that's 8:30 a.m. Chicago time, which would be 9:30 a.m. Eastern time. These are in the US, none of you are in the US, so I don't know how helpful that is, but I can tell you it's 2:30 p.m. London time. So if you can do the math from London, then you'll know. Yeah, should be 4:30, although at that point, yeah, it should be 4:30, exactly. So they'll be on Saturdays, so they don't interfere with your work, although try to get your work to pay for it, then it's cheaper for you. So we have 3 modules. Let me just get going. We've got financial acumen. That's the first one. I will start you off. So there we're going to talk about the goal of the firm. We're going to be able to learn. We're going to learn how to read financial statements, understand what type of content is in these financial statements. We're going to analyze them, and then we're going to use that information to forecast the future. Think about capital budgeting. Should we take projects or not take projects? How do we allocate our capital, and how do we value the company? So it's really good to have a picture of from the very beginning, like our goal is to maximize shareholder value. These are all the things that happen, and this is what shareholder value is. So I'm going to talk more about that later, so I'm going to spend too much time. So that's the first module, and that would be the first 3 Saturdays. They're not in a row, they're like every other Saturday. After that, we're going to take a couple of those things that we do in companies and expand upon them. And probably the most important thing, kind of the heart of the matter for any company, is strategy, right? So you can think of first 3 weeks as giving you the tools and the framework for thinking about creating value. And then the next 3 weeks are going to be the strategy of creating value for a company. So your professor is excellent. He's very famous and he is won a lot of teaching awards. He knows what he's talking about and he can make it in a way that you understand very easily what he's talking about and can take that back to your own teams. So we'll think at the beginning, it's a strategy class. So about how do we look at the industry? Is it a profitable industry? How do we know? What's buyer power? What's supplier power? Who's making the money? Who's not making the money? What's the market share? So we're going to learn how to understand what's going on in the industry and then how to compete. And what does that mean for things such as pricing, promotion, and these other things. We're then going to focus on one specific part of strategy, which is creating competitive advantage, right? So competitive advantages we either create through a cost or better quality. So basically we either charge the same price and give them better quality, or we figure out a way to be cost lower and sell at a lower price. Yeah, better delivery, that's right. Just something about the combination of all of the things that we do makes us be able to deliver at a better price. Sometimes our competitive advantage comes from the government or from a patent or for things like that. But we are going to think about short run competitive advantage and long run. And we'll call that sustainability. Yep. That's right, Avinash. So that will be the second week. And then the third week, we're going to think about the corporate growth strategy. So I always kind of think of competitive strategy versus corporate strategy. So with corporate strategy, it's more at the company level, whereas competitive strategy is at the business unit level. Okay, so we're thinking about how we operate within the industry. And so with the corporations themselves, we're going to think about how do we grow, good growth versus bad growth. I'm sure that's profitable growth versus non-profitable growth, right? Sometimes we grow and we just get bigger, but we're not really creating any value. That's right, Adjunct. We'll talk more about value creation, diversification, and then he'll talk about mergers and acquisitions. All of this stuff that we're going to talk about requires a lot of tools, and that's what we'll do in the first 3 weeks. So the first 3 weeks, remember, we're going to lay out the big picture for you. We're going to work with you to get your toolbox all set up a framework, and then the next 3 weeks, we're going to focus on strategy, right? It's going to be very valuable. The third week is a little bit of a departure from that. The third week is about decoding fintech. What do you think about that? What do you think about that title? I love that title. I think it's kind of cute, right? Since we're doing coding with fintech. Anyway, I like it. So your professor here is Zacheng Xu, who is a leader in this field. He has a reputation for being able to take these concepts and express them in ways that is accessible for people, right? So when I think about where does fintech fit in, right, we should be thinking about perhaps a lot of it might be on the operation side of the company. So we're going to think about what is fintech, what is AI, machine learning, and big data, and what is NLP. Does anyone know what NLP is? I had to look it up. Yeah. Yes, they are. We want to be specific. I like to be specific. So does everyone else here, right? Yeah, I think it's natural language processing, but they both sound good to me. Yeah. I mean, as we move on, and I noticed that some people had questions in the IT field. Um, a lot more and more, we're going to have to think about these things and how we can take advantage of technology to create value for our companies, especially to be in front of these things, right? Not be late to the game. So he will talk about, he's going to clear everything up. That's why it's decoding fintech. We'll talk about the promises of fintech. It's not a cure-all. There are some pitfalls. And he's going to talk about things like, these got these cases, P2P lending, Zillow offers, robo-advisors. But really what, you want to be thinking about things like, how do companies use these? They could use them for credit scoring, right? They can use it for valuation, fraud detection, portfolio management. I mean, there's so many things. And even if you're not doing the tech, even if you're using the tech, how do you use it, right? Robotics, etc. So this, I think, will be fascinating. This will be 3 weeks in a row, well, every other weekend, that really is going to clear up the language of what fintech is and how it can be used, what cryptocurrencies, etc. Okay, decentralized finance. So I think this is a wonderful opportunity to learn about these things with an expert. So, and then finally, so we've done 3 weeks. We've done our framework with the financial tools. We'll have a deep dive into strategy, and then we're taking a dive into fintech and how does that fit into modern companies, right? What works and what doesn't work. And as Avinash said, AI, ML, and big data are most abused words. Yeah, let's get to the bottom of that, right? What does this mean? When I think of AI, I think of science fiction novels, which I like. So how does that impact businesses? And then finally, we will do valuation. So we're going to take everything that we did so far, and we're going to wrap it all up in a bow. The goal of the firm is to maximize current shareholder value. We do all this stuff. Where does value come from? And so at the end, you'll be able to have a framework in your mind and some theories and experience and history and content on how to create value for your company. That's the big part. We only have 90 minutes, Avinash. But I'll do what I can. I'm going to do that section as well. So 90 minutes to do all the valuation, but maybe we can add a little bit. We'll do a little bit of an add-on. We can talk about it. Send me a note. Okay. So now what I want to do is take a deeper dive into the financial acumen section of our program. So when we think about, I'm not going to read everything off, but when we think about financial acumen, these are the things that we'll be covering. So you'll have a list here. I think that Rashid could provide you with the annotated slides if you email him. Is that true, Rashid?
Yes, we'll provide it to everyone.
That'll be great. Thank you so much. The team at XED and the team at Chicago Booth are excellent at answering your questions and making sure that you are supported and giving you guidance on whether the program is a good fit for you. So please don't hesitate to reach out to them. So when I say, what is the goal of the firm? What do you say? I wrote up here, maximize current shareholder value, right? Is that what you would say for the goal of the firm? We'll think about a public company today, just because for not startups and not small private companies. But when we say what should companies do? When I say maximize current shareholder value, what does that mean? I feel like that's not really too cliche. I really feel like that is my main objective function, right? Maybe people use it in a cliche way, but we're not using cliches today. Yeah. Well, the goal is if you maximize current shareholder value, you will have to maximize the other stakeholder values along the way, right? Because no one's going to want to work for you. People won't supply for you. You have to run a good business. If you're not running a good business, you're not going to be maximizing shareholder value. So I'm not going to maximize, say that I own shares in a company and I vote for the board of directors and the board of directors hires management. I can tell you right now, I'm not going to be very happy if the managers of companies that I own are maximizing the value for suppliers. That's not it. They maximize the supply value for me, right? Now that doesn't mean that I don't want them running a good, efficient, ethical business, right? But their goal is to maximize shareholder value. So what is shareholder value? Shareholder value is the price per share. Let's think today only of public companies, just because we have to have one example, and today is just an overview. So the price per share times the number of shares outstanding. This is how we measure shareholder value. Just think of yourself as owners of the company. You may own some of the shares. Now, shares outstanding, yeah, we should be ethical. Shares outstanding, it doesn't really matter if I cut this, we'll call it a pizza pie, into that many slices, or if I add, a few more slices. I'm not changing the perimeter, right? That's the number of shares outstanding. It's not really changing the value of the firm, if you were to think of this as the value. So where's the action coming from? The action comes from price, right? And yes, and I do mean long-term intrinsic value. So the true value, when I say maximize shareholder value, that doesn't mean that you should manipulate things so that the stock price goes up. What we really mean is making this a valuable company. Okay, so the action comes in the price per share. And what we're going to learn for price is the present value of the expected future cash flows to the asset in question. So for example, share price. So we're going to learn that when we want to value something, we need three things. We need time value of money. And when we talk about time value of money, we're going to talk about how do we bring money back in time, right? Number two, we're going to need, what are we bringing back in time? We have to have some idea of the cash flows being generated by the company. And the cash flows that go to equity holders or to debt holders. And number three, we're going to need what we call a cost of capital or a discount rate. We need some type of rate to bring money back in time with. Okay, so we will learn all about time value of money. So let's say, for example, if I want to value equity, that's what this is. Shareholders are equity. We need the free cash flows to equity holders. So what does that mean? It means, we'll talk about what does that mean? Well, after you've run the business and made the investments that you needed and paid off your debt holders, what cash is left for owners, right? So there's lots of ways that people do it. We can either, we can value the firm directly. And then the cash flows will be all the cash flows generated by the company. We can subtract the value of the debt. Sorry, I'm still getting used to writing early. We're left with the value of the equity. We can divide by the number of shares. and we get a price, right? That's one way to come up with the price. Another way we can do is we can value the equity directly, which not so many people do. Normally, when we do a valuation, we're going to value the firm. We're going to take out what we owe to our debt holders. We're left what belongs to the owners. If you divide that by the number of shares, you will get the price per share. Okay, so we're not doing that today, but the idea is we're going to maximize shareholder value. To be able to do so, we need three things. We need to know how to bring money back in time. So for example, if I tell you I'll give you $100 or euros or whatever 3 years from now, what's that worth in today's dollars, right? That's what that's saying. We need to understand what are the cash flows going to the owner of the asset, whether it's debt or equity or something else. And then what do we bring that money back in time with? Okay. So that will be our goal. So look at Starbucks, for example. So Starbucks has a market cap, or did on October 24th, of $96.7 billion. That's for their equity. How? They have a price per share, it's in US dollars, of 84.26, and they've got 1.147 billion shares outstanding, gives them a market cap or market value of almost 97 billion. But look what's going on here, right? Like the prices changed. They're all over the place. They're down here. There was a drop. What happened here, by the way? That looks to be around March of 2020. Any guess? COVID. Yeah, our favorite 5-letter word. COVID. Things dropped. So you can imagine if you're a company like Starbucks. So let me tell you, let's say that the value of the firm, we can value the firm in general, or we'll do the value of the equity. The value of the equity equals the sum of, that just means add up, the expected free cash flows to equity in period T brought back in time. So the numerator is the free cash flows and the denominator is the discount rate, right? So why would price change? What could happen? Well, if we're using a discounted cash flow model like this, it can only be that the cost of capital changed or that the free cash flows changed, because math is not changing, right? We needed math, cash flows, and a discount rate. So if you were looking at Starbucks, why do you think when COVID came that their value dropped? Why do you think that the price dropped dramatically? And it, Starbucks is just one example. Could be any company and many companies. What do you think that shareholders thought? Yeah, cash flows, exactly what Deepak says, right? So I'm sitting there, the world is closing. Starbucks is a retail business and people became unsure, right? So people were thinking, oh, darn, those cash flows are going to go down. If the numerator goes down, the value goes down. Another thing that we'll learn about is, when we bring this money back in time, what is this R? And what it is, it's the risk-free rate. What you could get, for example, for a government bond plus a risk premium. Now, speaking for yourself and the others, I'll speak for myself. Do you think that people so the risk premium is what we need to pay shareholders above what we would pay, what get paid by a government bond? And it reflects how risk averse we are. So what do you think? Do you think that during COVID, people became more risk averse? Yes, right? I mean, we didn't know what was going to happen. Are we going to lose our job? Should we really be putting money in the stock market? So I think people got more risk averse as well. So the risk premium also went up. And so that was like a double whammy, right? The numerator goes down and the denominator goes up. So prices dropped, and they dropped pretty quickly in March. But then what happened? We recovered. We got Starbucks had delivery service, right? They figured that out a way, and cash flows built up again. Now then we have like the war and other things going on, and things are picking up a little bit again. Yeah. So what we want to be able to do in this class is understand this, right? Specifically, we want to understand what are these free cash flows? What affects them? What is this discount rate? What affects the discount rate? Yep. So when we think about why prices change, it could be changes to cash flows. You know, another thing to think about while we're at it is the risk-free rate. That's a nominal rate. And that is equal to the real risk-free rate, plus expected inflation. So expected inflation is another way to affect the risk-free rate that would affect the discount rate. And you know that what's been going on with inflation. You think people, for a while there, they were expecting inflation to rise, right? Now maybe they're expecting the opposite, but these expectations get built into price, and that's why it's very important as a leader and a manager to understand also the macroeconomic environment of where we're at. Yeah, that's right. People had all those checks and they were spending them. So you will, if some of this seems, I'm sure most of this seems foreign to you right now, but these are the kind of things that we'll do in class, right? So how do we affect things? We're not going to affect the macroeconomic environment. We just need to be able to understand it and operate within it, right? But what do companies do? So the main activities of the companies are strategy, which I said was the heart of the business. So we come up with our strategy. This could be competitive strategy, corporate strategy, marketing strategy, right? What's our go-to-market strategy? What's our strategy at the business unit level? What's the corporate strategy? Should we be horizontally integrated, vertically integrated, these types of things? Investing. Once we have a strategy, what investments do we need to make to put our strategy in place, right? Well, for you to be able to decide what investments to make, you need to have some kind of decision rules, right? So we'll talk about things like net present value, payback, internal rate of return. We'll think about ways for you to evaluate whether you should make investments or not, right? But in general, we're going to think about what's our strategy, what investments do we need to make them happen, how do we pay for them? So how to finance the investing and operating activities of the company, right? Should it be with retained earnings? Should it be that we issue debt? Should it be that we issue equity? Should we do supplier financing? I mean, how are we going to finance our investments? And then the operations itself, this is running the business. Right? So that's where we think about where do revenues come from? Right? Revenues are price times quantity. So how do we get the volume up? What influence do we have on price? It really does depend on how much market power we have. How much market power we have depends on our competitive advantages. Yeah, of those, the equity is the most expensive. That's called the pecking order theory. So on the operating side, it would be about running the business. Now, that's not enough, right? So some of you are in functional roles, maybe some of you are in operations, some of you are in investing, some of you are in strategy, but a leader, right? Where you're headed, if you're not already there, I'm sure you're a leader in some ways already. You also need a lot of other skills, right? You need to have good management, leadership skills, decision-making, and negotiation skills. So in fact, if you were to go back to school someday or already have and done a master's degree in business administration, that's kind of how a program is set up, right? You got your core functions and you have the things that put it all together. And so we'll be helping you with that in this program. It's 10 weeks, it's not an MBA program, but it sure is a very cost-effective way to get this type of knowledge over a period of time. Yeah, I think you'll enjoy it. So we're going to talk about these activities. Activities what? Activities that we can use to help us maximize shareholder value, create value for the company, right? So then we want to know, well, where do we see the results of these activities? So we will be focusing on, we will look at financial statements. Evidence, you're going to have to define that term. Sorry. I don't know what it means. So when we're going to look at the financial statements, what are the main financial statements? Can you guys write like the 3 main financial statements in the chat? Oh, you mean a real sophomore student at a university? I would say it might be a little advanced, but it would be a good way to get a big picture that they might not be getting in school. Yeah. Depends on the aptitude of the student. Good students, ability to see big picture, yeah. Definitely wouldn't hurt. But it's a very expensive program for a younger person. So it makes sense for adults for sure, because you'll be able to immediately see the impact and recoup your investment in the course. I'm just not so sure. You should talk to the advisors. Talk to Rashid and ask them. Okay. So yeah, we've got 3 main financial statements, and we will learn what's on these financial statements, okay, and how to read them. So the balance sheet tells us investing equals financing. Telling us about the investing activities and the financing activities. The income statement is telling us about operating activities. Are we profitable, right? Where is the revenue coming from and where is it going, right? We also have occasionally some non-operating activities on there. Say if we sell off an asset or retire some debt early. But for the main part, the income statement is telling us about the operation, telling us what happened over the period. And then the statement of cash flow is telling us the sources and uses of cash over the period from operating, investing, and financing activities. So, you know, our goal is to maximize shareholder value. We have a lot of tools at our on hand, right? We could think about our strategy, what investments we make, how we pay for them, how we run the business. But where we see the result, we look to the financial statement. And so we will spend a little bit of time. This is very small. I'm not going through them. They're up there more mainly for impact. So for example, you know, like, oops. This is the balance sheet, and what type of things? Balance sheet, this is about our investments. The other side is about our financing. The income statement is about operations for the most part. The statement of cash flow has 3 sections: operating, investing, and financing. And what we want to be able to do, we want you to be able to look at these financial statements and understand what's on them, right? So one of the things that we will do is that. Even so, having financial statements is not enough. We're going to need to know how to analyze them. So we're going to talk about some popular way to analyze financial statements. So if we want to look at profitability, we're going to think about return on assets. So we can do operating income. It could be before tax. It could be after tax over average assets. So we're going to say for every dollar of assets employed in this business, how much do we keep? What's our operating earnings, right? From the income statement. And so operating income, for example, at Starbucks, right? We'll learn to look at things and say, oh my God, what must have happened in 2020? And of course we would say, oh yeah, that was COVID, right? Okay. Well, I just made everything bigger. So we'll learn how to read those things. But again, we want to be able to analyze it. So we start with return on assets, then we break it down into profit margin and asset turnover. And we will then break that even further down into expense ratios and turnover ratios. So turnover ratios are going to be telling us about our efficiency with using assets. Our expense ratios are going to help us with our cost structure, right? So for every dollar of sales, where's the money going? How much goes to cost of goods sold? How much goes to selling expenses? How much goes to R&D? How much goes to salary? How can we improve these things? So we'll talk about ways to improve our cost efficiency, and we'll talk about ways to improve our working capital or long-term capital efficiency. So how many days does it take people to pay us? How many days do we hold our inventory? All of these things feed into profitability, and we compare that with the cost of capital. Right? If it costs us on average 10% to get capital, and we're only earning 9% off that capital, we're not doing very good, right? So we'll use this as a way to think about what we call value-based management, ways to increase the value of the company using these methods. So we'll think about profitability. We'll talk about risk, short-term risk, long-term risk. Short-term is liquidity. Can we pay our bills? Long-term is solvency. Can we stay in business? So we'll cover that. We'll talk about the time value of money, right? If I gave you that $100 3 years from now, what's it worth today? If I gave you $100 3 years in a row, what's it worth today? If I gave you $100 a year forever, that's a perpetuity. What's that worth today? And if I gave you $100 next year, 105 the year after, 110.25 the year after, a growing perpetuity, what's that worth in today's dollars? Why do we have them? Because those are the building blocks of valuation and capital budgeting. Right? Remember, we're maximizing shareholder value. We're also making investments. For us to be able to decide what investments to make, we have to know, we have to have a benchmark. We have to be able to compare the present value of what we're paying to the present value of what's coming in. That's called net present value. So we will learn how to bring money back in time. If you know these 4 things, you can do the mechanics behind any valuation. Of course, you can do an Excel anyway. So remember, we needed time value of money, we needed cash flows, and we needed a discount rate. We will in class talk about where do the cash flows come from, which of course means we have to say what cash flows. Well, it depends on what we're valuing. If we're going to value a company, it's one thing. Equity, it's another. Debt, different cash flows. Value a project, something else. right? So anytime you try and do forecasting, it's no different than when you try to put a budget together, right? So we got to figure out what cash flows we're talking about, and we have to make a financial model, for example, for putting that together. Okay, so we'll talk about when you're making assumptions. These are some of the uncertainties or things that you need to think about. And then when we actually come up with the cash flows, we'll say what they are. If the firm borrows money, well, it's the principal and the coupon payments are the right cash flows. If we're trying to value the equity directly, it's what's left over after we satisfy our operating and investing activities and our other financing activities. If I want to value the firm overall, I just want the cash flows generated by the company. If I'm going to value a project, I want the cash flows with the project that we wouldn't have without the project. So we'll talk about those 4 things. Not today, but we're going to have ways that you will learn what these cash flows are. You'll know what analysts are doing. Then we need to come up with the discount rate. So when we said that price or value equals the sum of expected free cash flows brought back in time, we're now saying, what's this? And we've got to come up with that number. That's called the opportunity cost of capital. It's called the opportunity cost of capital because it's what we would have to return or pay to investors in an equally risky environment, equally risky project over the same time horizon. So we will teach you and we'll talk about how do we come up with that cost of capital, right? Which discount rate? Well, if we're valuing debt, we should use the cost of debt. If we're using value equity, we should do the cost of equity. If we're valuing the firm or a project, we very often use what's called the weighted average cost of capital. Or depending on the valuation method we use, we can use asset cost of capital. Depends on the valuation method. And we will talk about valuation method. Weighted average cost of capital just means we look at how we finance our assets or our investments. And let's say that we had let's say we had 40% debt and we had 60% equity, and our equity cost us 10%, and our debt cost us 5%, and our tax rate was 25%. I'm going to make my debt less expensive. Then we would say, well, what would be our cost of capital? So we look taking a weighted average, right? So that looks like 6.4% or something. And I'm doing the math fast in my head. So we would use that as a way to come up with our cost of capital. And we will talk to you about where does this come from? Where do these equations come from, right? What does it mean, cost of capital? What's the cost of capital for one industry versus another, right? These types of things. We'll use something called the capital asset pricing model, where that helps us say, well, the expected return should be a risk-free rate plus the risk premium. And we'll want to know, where does that come from? So then we'll spend a little bit of time. I know I'm running out of time, so I have to go a little bit faster. We'll talk about capital budgeting. Should we take a project or not? How do we decide? So these are the decision metrics. Like some people would say payback, how many years before we get our money back? We'll say that's not really the best way because it ignores the time value of money. Some will say, well, we can at least discount those cash flows. Okay, that's a little better. We'll talk about net present value. We'll talk about internal rate of return. We'll talk about the pros and cons to the different methods, although there's not too many cons to net present value, right? That's what I would use. So we'll talk about, should we take on a project? And then I think that is probably very important and underrated is this question of capital allocation, right? One of the most important roles of the CFO and the CEO is to decide what to do with capital. And so we're going to talk about these things, right? So if we ask ourselves, do we have excess capital, right? So do we have positive free cash flows? If we don't, well, then we need to focus on our operations, okay? But if we do, what do we do with it? If there are positive NPV investment opportunities available, we should take them, right? Yes. So we would invest. How are we going to invest? Either organically, a little bit slower, but less expensive, or through M&A, right? We have to decide. If we have to make sure there's positive things. If there are no positive projects available, then what do we do with the cash, right? If we need to pay down some of our debt, well, we could retire, or we could just hold some excess capital just in case. If we don't need to pay down any debt, we have plenty of cash flows. If these cash flows are going to be for the long run, well, if they're going to be for the short run, then what do? Well, we could do a one-time distribution, like a special dividend, or tender offer means a stock repurchase. If we do expect to sustain it, then we can initiate an ongoing dividend, right? Maybe an ongoing share repurchase program or a regular dividend program. So we're going to talk about that because this really gives you a good idea of what's going on in the business. If you can understand these flows, you know more than, I don't know, most people. And by most, I mean like 90%. Yeah, maybe even higher. And then, like I said, we're going to wrap it all up with valuation. So let's just think about, we want you to think about where you are. So let's say that we're all here. We all have different roles. So we're going to be different pen colors. We all do different things, right? Strategy, investing, financing, and operating. These are the main activities. These are our tools. We see the results in the financial statements. We use financial statement analysis. We look at profitability, risk, and growth. Okay. And with that information, we would forecast future financial statements, forecast free cash flows, estimate a discount rate, calculate the present value. This will be equal to the value of the firm. We could subtract the value of the debt, and we come up with the value of the equity. So if our goal is to maximize this, we have a direct chain of events, right? So when you're in the strategy section, what strategic things can we do to increase the value of the firm and the equity? When we think about fintech or robotics, how can that help us be more efficient in the operations? And what would be the final impact down here on the value of the equity? So that took me a little bit of time, sorry. Was that helpful? Do you have a good understanding of what we would be doing in the financial acumen section? To find it appealing? I think it will be very interesting for you. Yeah. You will walk away with a very good broad picture, plus know how to do stuff, right? Should be very engaging. So if you are interested, and I hope you are, it would be lovely to be in a class with you. There's the program fee, there's the duration, there's 10 sessions. If you go to XED site, they have all the information that you need, and they have advisors that can help you decide what program is whether good for you or not. Chicago booth, Allison and Lucia on this call, they have put together a very nice website that also gives information on this program. So I'm hoping that you'll go check it out. I didn't want to spend too much time. I'm more of an academic than a salesperson. But I think it's a valuable program. I have to say, I think it's going to be very well done. I'm I'm really happy to work with the faculty that I'm working with, and the team on the ground at XED and Chicago booth are amazing and can really help you with your search and your decision. So eventually you'll be your name here, right? You'll get a certificate when you're done. And yeah, it will be great. I don't know who will be signing it, but any questions for you all? Oh, Rashid put the, if you have a question, you can write it in the chat or you can just say it out loud.
Hi, am I audible?
Yeah, I hear you.
Yeah, just wanted to understand, will we get the full alumni status?
Okay, so Lucia, do you want to answer that? What the alumni status is?
For students
there?
that participate in executive education programs such as this one, the alumni status is slightly different than what a participant that completed an MBA will receive. There is still some recognition that's provided to you, and I believe that's also available on the website. I can put that in the chat in a second.
Yeah, I know that you will be, you will get access to our executive ed LinkedIn pages and things like that, but you will not be for sure get the same alumni status as the MBA students. Yeah. Yeah. Anyone else have questions about the content or about administration, anything like that? You're asking if there's an early bird discount. That's Rashid.
Avinash, do write to us on chicagobooth.epfs@xcdinstitute.org. We'll assist you on this query.
Adwash, the class is online only, no live sessions, 10 classes. Plus you'll work in between. I have this one exercise, it's called Identify the Industry, which I really love. And so there's 14 companies and we show you their financial statements and then you've got to match the financial statements to the companies. So it's pretty challenging. What we'll do is we'll set up a Google Sheet with optional study groups in case you guys want to get together and work on things. So Deepak, on the financial modeling, it will be broader. It will not be, this is exactly how to build a financial model. Like we're not going to walk through the Excel. We'll tell you what the assumptions and what you would do, but it will unlikely be a full-blown financial modeling course. These sessions should be recorded. I will, Avinash. The sessions are recorded, right? Yeah, they're recorded. If you miss a session, then you watch the recording. Yeah. Correct, Rashid? Yeah, that in this day and age, they would have to be recorded. Yeah. The class size will depend on you. I don't know. It's our first offering. So hopefully we would have like 40 people, but 20 people would work. Depends. Sometimes I have classes of 100. Sometimes I have classes of 20. Yeah. No, Manoj, you'll get the certification for completing, as far as I know. Rashid, there's no exam, right?
There's no exam, but they'll have live quizzes in the session.
Yeah, we will definitely give you live quizzes. Yeah. Gaurav, there will be no in-person sessions, but all of the sessions will be live online. So what we're doing right now. We'll definitely have that. Yeah. Which I think is fine. I mean, because I'm kind of used to it. I like it now. Well, I actually always liked it. It's not very far. It's a very short commute from my bedroom to my office. Yeah. Very short. Yeah. All right then. Well, if you don't have any more questions, we'll let you go. But please reach out to the teams. We would love to see you in the program. You could be part of our first class. Don't forget, it's the first class that we're doing with XED. It's not the first class that we've ever done. So, yeah, I'm really happy that you came. Yeah. All right. Thank you very much and have a wonderful night. Rashid, did you have
Thank you.
anything you wanted to add?
No, I think you've covered it. Well, thank you so much for taking out the time.
Thank you. Lucia, are you okay? And Allison?
Thank you. Thank you, everybody. And thank you, Kathleen. We're
thank you.
excited and we'll continue the conversation if anyone has any follow-up questions.
All right. All right. That sounds great. Take care, everyone.
Goodbye.
Rashid, you got the recording. I'm going to stop the recording. You have access to the cloud, right?
We have it.